You know something funny? People always think they need millions to get started investing. They wait and wait and wait for that perfect moment when they'll have enough money. But here's what I learned. Managing the Magellan Fund, $100,000 is all you really need to build real wealth in America. Not to get rich overnight, but to start the kind of compounding machine that can change your life. Let me tell you why that number matters and why most people get it completely wrong. When I started at Fidelity back in the 1970s, I watched thousands of ordinary Americans, teachers, plumbers, bus drivers, turn modest amounts into fortunes. Not because they were geniuses, but because they understood something Wall Street doesn't want you to know. The game isn't about having the most money to start. It's about having enough to begin serious compounding and the patience to let it work. $100,000. That's the magic number I saw again and again. Not because there's anything mystical about it, but because it's the point where regular investing starts turning into something extraordinary. It's where the snowball gets heavy enough to really start rolling downhill on its own. Think about it this way. If you've got $1,000 and you make a fantastic 20% return in a year, you've made $200. That's great, but it's not life-changing. You're still basically starting from scratch. But if you've got $100,000 and you make that same 20%, suddenly you've made $20,000. That's real money. That's money that starts working for you while you sleep. I remember talking to a nurse from Boston who came to one of our shareholder meetings. She'd saved up about $95,000 over 15 years of careful living. She was nervous, asking me if that was enough to really invest in stocks. I told her what I'm telling you now. She had crossed the threshold. She wasn't rich yet, but she had enough firepower to build something meaningful. Here's what most people miss. They think investing is this mysterious thing that only Harvard MBAs can understand. Complete garbage. I went to Wharton, and you know what? The most successful investors I knew weren't the ones with the fanciest degrees. They were the ones who understood businesses from working in them, shopping at them, using their products every day. That nurse? She worked at a hospital. She saw which medical supply companies had products nurses actually liked using. She noticed which pharmaceutical companies made drugs that doctors prescribed most often. She had an advantage over every Wall Street analyst in those air-conditioned offices downtown. She just didn't know it yet. But she had something else going for her too. She had $100,000 ready to deploy. And that changes everything. See, when you've got that kind of capital, you can build a real portfolio, not some dinky collection of 2 or 3 stocks where one bad pick ruins everything. No, with $100,000, you can spread your money across 10, 15, even 20 solid companies. You can own pieces of businesses in different industries. You can sleep at night knowing that if one company hits trouble, it won't destroy your entire financial future. Let me break down exactly what I mean. If you've got $100,000 to invest and you're thinking like a sensible person, you might put $5,000 or $10,000 into each position. That gives you 10 to 20 different bets. Some will be home runs, some will strike out. But if you've done your homework, and I'll show you how, your winners will more than make up for your losers. This is where amateurs have a huge advantage. You don't need to invest in 100 companies like I did at Magellan. You can focus on 10 or 15 businesses you actually understand. Companies where you shop, where you work, where your neighbors work. The ones making products you see getting more popular, not less. I found Dunkin' Donuts not from some fancy research report, but from noticing the parking lot was always packed. I found Taco Bell because the lines kept getting longer. I found Hanes because Leg's pantyhose were flying off the drugstore shelves. These weren't secrets. They were obvious to anyone paying attention. But here's the thing, paying attention only helps if you've got the capital to act on it. With $100,000, you've got that capital. Now, some of you are thinking, Peter, I don't have $100,000 lying around. I get it. Most people don't. But here's what's interesting. Getting to 100,000 is actually the hardest part. It's harder than going from 100,000 to 1 million. Way harder. Why? Because when you're starting from zero, you're fighting against time and small numbers. Every dollar you save is a dollar you can't spend on the things that make life easier right now. It takes incredible discipline. You're driving the old car while your neighbor buys new. You're packing lunch while your coworkers eat out. You're saying no to vacations, no to upgrades, no to keeping up with everyone around you. That's brutal. That's where most people quit. But if you can get to 100,000, something magical happens. The compounding starts doing real work for you. At 8% annual returns, which is actually pretty conservative for good stock picking, your 100,000 throws off $8,000 a year. Then next year, you're earning returns on 108,000. The year after, on 116,640. The snowball is rolling. Give it 10 years at that 8% and your 100,000 becomes 216,000. Not bad, right? But wait, what if you're still adding to it? What if you're putting in another 10,000 a year from your salary? Now we're talking serious wealth building. After 10 years, you'd have over 325,000. After 20 years, you'd have over 925,000. After 30 years, you'd have over 2.3 million. And that's with pretty conservative 8% annual returns. If you actually find great growth companies, the kind I specialized in, your 10 baggers, your 20 baggers, those numbers get silly fast. Let me tell you about a real example. In 1977, you could have bought shares in a company called Walmart for about 50 cents a share adjusted for splits. Most people had never heard of it. It was just a discount retailer in Arkansas. But if you'd visited one, you would have seen something special. Clean stores, good prices, friendly service, and parking lots that were always packed. If you'd put $10,000 into Walmart in 1977, by 1997 that position would have been worth over $5 million. 500 times your money. That's a 500 bagger. And this wasn't some biotech lottery ticket. This was a store you could drive to and walk around in. Now, I'm not saying every investment works out like Walmart. Most don't. But here's the beautiful thing about having 100,000 to work with. You only need one or two of those big winners to change your life. If you've got 100,000 split across 15 stocks, and 14 of them do okay or mediocre or even lose money, but one of them becomes a 20 bagger, you've more than doubled your total money. That's the secret Wall Street doesn't tell you. You don't need to be right all the time. You just need to be really right a few times and not catastrophically wrong the rest of the time. So how do you actually do this? How does someone with $100,000 build real wealth? First, forget everything you've heard about market timing. Trying to buy at the bottom and sell at the top is a fool's game. I never met anyone who could do it consistently. I certainly couldn't. Instead, you buy good businesses at reasonable prices and you hold them until the story changes. What's a good business? It's simple. A good business is one that makes a product or provides a service that people want, that's growing, and that's profitable. You want companies with something I call a moat, some advantage that keeps competitors from stealing all their customers. Maybe it's a strong brand like Coca-Cola. Maybe it's a patent like pharmaceutical companies have. Maybe it's just being really good at what they do, like Costco. Here's how I'd actually allocate that 100,000 if I were starting today. I'd probably keep about 10,000 inches cash or short-term bonds as my opportunity fund. Markets get crazy sometimes. Good companies occasionally go on sale for no good reason. When that happens, you want to have some dry powder to take advantage. That leaves 90,000 to invest in stocks. Now, I'd divide my stocks into categories, maybe 30,000 to 40,000 inches, what I call stalwarts. These are big, mature companies growing at 10 to 15% a year. Companies like Johnson & Johnson, Procter & Gamble, Microsoft, or Visa. They're not going to triple overnight, but they're solid, dependable, and they pay dividends. They're your foundation. Then I'd put maybe 20,000 to 30,000 inches fast growers. These are companies growing at 20 to 50% a year. They're riskier, but the potential payoff is bigger. This is where you find your 5 baggers and 10 baggers. Think about companies like Costco was in the 1990s, or Chipotle in the 2000s, or Netflix in the 2010s. You're looking for businesses with a great concept, room to expand, and management that knows what it's doing. Another 10,000 to 20,000 might go into cyclicals, companies whose fortunes move with the economy, auto companies, home builders, steel companies. These are tricky because you need to buy them when things look terrible and sell when times are good. But if you time it right, the gains can be spectacular. And maybe 10,000 to 20,000 inches, turnarounds or special situations. These are companies that are struggling now but have a clear path to recovery. Or companies spinning off divisions, or companies being taken over. These are higher risk but can deliver big returns if you understand what's happening. The key is diversification, but not over-diversification. 10 to 15 stocks is plenty, 20 at the most. If you own 50 stocks, you might as well buy an index fund. You're not going to track them all properly, you won't know the stories, and you'll dilute your winners with too many mediocre positions. Now here's where most people go wrong. They buy their 15 stocks, watch them for a month, get bored or scared, and start trading. They sell winners too early and hold losers too long. They listen to the financial news channels telling them to do something, anything, to be active. That's poison. I held Fannie Mae for 10 years. I held General Electric for years. I held Walmart for years. My best returns came from the stocks I almost forgot I owned because the story was still good and the business kept performing. There's an old saying on Wall Street, even a monkey can pick stocks, but only a human can hold on to them. Most people don't have a holding problem, they have a selling problem. They sell way too early. Here's another critical point that people with 100,000 need to understand. Time is your friend. Not a month, not a year, decades. I managed Magellan for 13 years. If you'd invested at the beginning and held the whole time, you'd have made 29% annually. But most of my shareholders didn't get those returns. You know why? Because they got scared during the bad years and sold, or they got greedy during the good years and tried to buy more at the top. The market is going to go down, guaranteed. It might drop 10% this year, it might drop 30% next year, it might drop 50% in some terrible crash. That's not a bug. That's a feature. Those drops are when you make your real money, because everything goes on sale. If you've got 100,000 invested and the market drops 30%, you're going to feel sick. You'll be looking at 70,000 thinking you made a huge mistake. But if you bought good businesses, businesses that are still making products people want, businesses with strong balance sheets and good management, then nothing fundamental has changed. The stock price went down. So what? The business is still good. In fact, this is when you deploy that 10,000 you kept in cash. This is when you buy more. I know it feels wrong. Every instinct is screaming at you to sell and run away. But this is when fortunes are made. I remember October 1987. The market crashed 22% in a single day. People thought it was the end of the world. But by 1989, the market had recovered everything and then some. The people who sold in a panic locked in losses. The people who held on or bought more did fantastically. Or look at 2008, the financial crisis. Banks failing, companies going bankrupt, unemployment spiking. The market dropped 50% from peak to trough. If you had 100,000 at the peak, you watched it fall to 50,000. Brutal. But by 2013, the market had recovered completely. By 2020, before COVID, it had more than tripled from the 2009 bottom. This is why you need that 100,000 to start with. Because you need enough positions that you can weather the storm. If you've only got 5,000 or 10,000 total, you might panic. But if you've got 100,000 spread across 15 good businesses and they all drop together, you can think rationally. You can remember that businesses don't disappear just because their stock price fell. You can hold on, or better yet, buy more. Let me tell you something else about that 100,000 threshold. It's psychological as much as mathematical. When you've saved up that much money, you've already proven you have discipline. You've already proven you can delay gratification, live below your means, and think long term. Those are the exact traits you need to be a successful investor. The people who can't save 100,000 usually can't hold stocks through a bear market either. They're too impulsive, too emotional, too focused on the short term. But if you've got 100,000 saved up, you've already passed that test. Now, I want to address something that stops a lot of people. They say, Peter, the market's at all-time highs. Should I wait for a crash to invest my 100,000? Here's the thing about waiting for crashes. The market is at all-time highs most of the time. That's how it works. It goes up over time. If you'd waited for a crash in 1995, you'd have missed the huge gains of the late 90s. If you'd waited for a crash in 2010, you'd have missed the entire decade-long bull market. Plus, you don't know when crashes are coming. Nobody does. I didn't predict 1987. I didn't predict 2000. I didn't predict 2008. Nobody consistently predicts these things. And the people who try to time it usually do worse than the people who just stay invested. So what do you do with that 100,000 if you're nervous about market levels? You dollar cost average. You invest a portion every month for 6 to 12 months. That way you're buying at different prices. Some higher, some lower. It averages out, and it keeps you from trying to be a hero and time the market. But whatever you do, don't let that 100,000 sit in a savings account earning 0.5% while you wait for the perfect moment. Inflation is eating away at it. Every year you wait, you're losing purchasing power and missing out on compounding. Let me share a specific example of how this works in practice. Say it's January 2010. You've saved up 100,000. The market crashed in 2008, recovered a bit in 2009, but people are still nervous. You decide to invest it anyway across 15 stocks. You put 10,000 into Apple, 7,000 into Amazon, 6,000 into Home Depot, 7,000 into Costco, 5,000 into Nike, 8,000 into Visa, 6,000 into United Health, 7,000 into Starbucks, 6,000 into Microsoft, 7,000 into McDonald's, 6,000 into Adobe, 5,000 into NVIDIA, 7,000 into American Express, 6,000 into Dollar General, and you keep 7,000 inches cash. Fast forward to today, 2025. Do you know what that portfolio would be worth? Over $1.3 million. That's 13 times your money in 15 years. And these weren't obscure companies. These were businesses you could see everywhere whose products you probably used. Now, I'm not saying those exact stocks are what you should buy today. I'm saying this is the power of having 100,000, spreading it across good businesses, and holding on. You don't need to find the next Google when it's a startup. You can find great businesses that are already successful and still have room to grow. Here's what's really interesting. If you'd put that same 100,000 into an S&P 500 index fund in 2010, you'd have about 420,000 today. Still good. Nothing wrong with tripling your money. But by doing a little homework and picking individual stocks carefully, you could have done even better. That's why I always said investing in stocks is fun and interesting if you approach it right. You're not just buying ticker symbols, you're buying pieces of real businesses. Businesses that make the cereal you eat for breakfast, the car you drive to work, the phone you use to call your mom, the stores where you shop on weekends. When you think about it that way, it stops being scary and starts being logical. You're just asking yourself, is this a good business? Is it growing? Can I understand how it makes money? Does it have advantages over competitors? Is the stock price reasonable compared to earnings? Those aren't complicated questions. You don't need a finance degree to answer them. In fact, having a finance degree often makes people worse investors because they overthink everything. I remember talking to a teacher once who told me she couldn't invest in stocks because she didn't understand all the jargon. I told her, "Do your students like the school supplies from Staples or Office Depot better?" She said, "Staples, no question, better quality and prices." I said, "There's your research. You just did more homework than most Wall Street analysts." That's what having 100,000 lets you do. You can put 5,000 or 10,000 into each of your best ideas, the ones where you've actually done the homework, where you understand the business, where you've seen for yourself that customers love the product. And here's the beautiful part. Once you've got that 100,000 working for you and it's compounding, you can keep adding to it. Maybe you add 5,000 a year from your salary, maybe 10,000. Even small additions make a huge difference when your base is already substantial. Think about it. If your 100,000 grows at 10% a year, in 10 years it's 260,000 without adding anything. But if you add just 5,000 a year, it's 350,000. Add 10,000 a year and it's 440,000. That's the power of combining compounding returns with steady contributions. And once you hit that first $250,000, then $500,000, then million, the compounding gets absolutely ridiculous. At $1 million earning 10%, you're making 100,000 a year just from your investments. That's a salary. That's financial independence. But it all starts with that first 100,000. That's the launch pad. That's what gets the rocket off the ground. Now, let me be clear about something. This isn't a get-rich-quick scheme. I'm not promising you'll turn 100,000 into $1 million in 3 years. Maybe you will if you find the next Apple, but probably you won't. What I am saying is that with 100,000, discipline, patience, and some common sense, you can build real wealth over 10, 20, 30 years. Some of you are thinking, Peter, 30 years is a long time. It is, but those 30 years are going to pass whether you invest or not. The question is whether you want to be 65 years old with $1 million or 65 years old with nothing. I met so many people during my years at Magellan who regretted not starting sooner. Not a single person who regretted starting when they did. Not one. The mistake most people make is thinking they need to wait until conditions are perfect, until they understand everything, until the market's cheaper, until they have more money. Until. Meanwhile, years pass, decades pass, and they never get started. If you've got 100,000 saved up right now, you're in the top 5% of Americans. Most people never save anywhere near that much. You've already done the hardest part. Now you just need to put it to work. And look, maybe you don't have 100,000 yet. Maybe you've got 50,000 or 75,000. That's okay. You're close. Keep saving. Keep working toward it, because once you cross that threshold, everything changes. The compounding that felt invisible when you had 5,000 or 10,000 suddenly becomes real, tangible. You can see it growing. That motivates you to save more, to stay disciplined, to keep learning about businesses. Here's my challenge to anyone reading this. If you've got 100,000 or close to it, commit right now to investing it properly. Not gambling on meme stocks or cryptocurrency or whatever the latest craze is, not trying to day trade, not listening to some guru on YouTube promising to triple your money in 6 months. Instead, make a list of 15 businesses you actually understand. Businesses where you've used the product or shopped at the store or worked in the industry. Write down what you like about each one. Look at their earnings growth over the past 5 years. Check if they're profitable. Read the most recent annual report if you're feeling ambitious. Then invest 5,000 or 6,000 or 7,000 inches each one. Spread your money across different industries, maybe 3 or 4 stalwarts, a few fast growers, a cyclical or 2, maybe a turnaround if you understand the situation. Then do the hardest thing of all, nothing. Just hold them, check on them once a quarter when they report earnings, make sure the story hasn't changed. If everything's fine, do nothing. Don't trade, don't get cute, just let them compound. In 5 years, look at your portfolio. I'll bet good money that if you bought decent businesses at reasonable prices, you're ahead, maybe way ahead. In 10 years, you'll probably be shocked at how much it's grown. In 20 years, if you held on and kept adding money, you might be financially independent. That's the power of $100,000 in the stock market, not 100,000 inches a savings account, not 100,000 inches bonds, not 100,000 inches gold or real estate or some complicated hedge fund, just 100,000 inches good businesses bought at sensible prices and held for a long time. This isn't magic. It's not complicated. It's just patience and common sense. But in a world where everyone wants quick results and easy answers, patience and common sense are actually rare, which is why most people never build wealth, even though the path is right in front of them. $100,000 is all you need, not to get rich tomorrow, but to start a machine that can change your life over time. A machine that works while you sleep, a machine that grows and compounds and eventually gives you something priceless, freedom. Freedom to retire when you want. Freedom to change careers without worrying about money. Freedom to help your kids or grandkids. Freedom to live life on your terms instead of someone else's. That's what $100,000 can buy you. Not yachts, not mansions, but freedom. And freedom, my friends, is worth more than all the yachts in the world. So if you've got it, use it. If you're close, keep saving. And if you're just starting, remember that every dollar saved is a soldier in your army. An army that's fighting for your financial independence. Keep building that army. Get it to 100,000, and then let compounding do what it does best. Turn patience into wealth. That's the real secret Wall Street doesn't want you to know. You don't need millions to start. You don't need luck. You don't need a finance degree. You just need $100,000, some good businesses, and the discipline to hold on while everyone else panics. It's not glamorous advice. It won't make you a millionaire next year, but it works. And in 20 or 30 years, when your portfolio has grown into something extraordinary, you'll look back and realize that reaching that first 100,000 was the most important financial decision you ever made. Because 100,000 isn't just a number, it's a threshold. It's the point where you stop dreaming about wealth and start building it. It's where hope turns into action and action turns into results. $100,000. That's all you need.